Today we delve into China's newly announced plans for fiscal stimulus aimed at reigniting economic growth. As the world's second-largest economy, China's economic strategies profoundly affect global markets. But Beijing's latest measures come with key questions about their scale and impact. From heightened debt issuance to targeted subsidies, China's policy approach seeks to stabilize growth while facing debt concerns, an uncertain property market, and pressures to increase consumer spending. But how significant will these measures be? And what could they mean for China's long-term financial stability? In a recent press conference, Chinese Finance Minister Lan Foan pledged that Beijing would significantly increase debt issuance to revive the economy. The main goals? Assisting local governments, offering subsidies for low-income households, bolstering banks, and stabilizing a real estate market struggling with prolonged uncertainty. But while the commitment seems strong, key details about the size and scope of this stimulus remain missing. For investors, analysts, and international markets, these uncertainties have created a cautious wait-and-see mood. Without a clear figure for the overall package, many are holding back from making optimistic predictions. This ambiguity has already impacted stock market rallies that began after Politburo meetings hinted at greater urgency. Now, many investors are hoping for answers at the upcoming session of China's National People's Congress, where additional debt issuance could be approved. A core component of China's economic strategy centers on helping local governments manage their mounting debt. While Beijing has long supported local governments with debt measures, the current landscape poses new challenges. Many municipalities are dealing with reduced revenues from real estate transactions, a major income source now threatened by the property market's downturn. Lan Foan suggested that around half of a proposed 2 trillion yuan, or about $284 billion, bond issuance will go toward alleviating local debt burdens. Alongside this, China will allow municipalities to repurchase undeveloped land from property developers, an effort to stabilize local budgets. Though these measures offer temporary relief, analysts warn that debt-driven strategies aren't sustainable. Structural adjustments to reduce local government reliance on debt are crucial if China wants to avoid exacerbating its financial imbalances. To boost consumer confidence in spending, China will introduce subsidies for low-income households. A proposed subsidy of 800 yuan, roughly $114 per child for households with 2 or more children, along with support for purchasing home appliances, shows Beijing's intent to address domestic demand. China's consumer spending, currently less than 40% of its GDP, lags significantly behind global averages, which hover closer to 60%. With low wages, high youth unemployment, and a minimal social safety net, Chinese household spending has long struggled to keep pace with overall growth. Beijing has pledged over the years to rebalance its economy toward consumption, but this requires fundamental shifts in both policy and social infrastructure, a significant challenge in a system so heavily reliant on state-led investment. The real estate sector, a backbone of China's economy, faces immense pressure from declining sales, slowing construction, and record-high vacancy rates. Recognizing this, the Chinese government has pledged measures to stabilize the property market, which may include easier access to capital for struggling developers and increased lending options for consumers. Reports suggest China may inject up to 1 trillion yuan into its major banks, which would provide them with additional lending power. However, weak credit demand poses a barrier. With consumers wary of economic prospects and a backlog of unsold properties, simply providing capital may not be enough to restore confidence in the sector. To sustain growth, China must carefully manage real estate risks while encouraging cautious optimism within both the consumer and investor communities. This is easier said than done in a market where structural weaknesses continue to surface. Following the Politburo's September meeting, Chinese stocks surged as investor hopes grew for a strong stimulus response. However, without a specific fiscal commitment, that enthusiasm has dwindled, leaving investors in a tense holding pattern. Economic data has been disappointing, with manufacturing and retail sales failing to meet forecasts and property sector statistics adding to concerns. Analysts warn that unless China can stabilize consumer demand and find a more sustainable growth model, the longer-term economic picture may look challenging. While the recent measures have lifted market sentiment slightly, economists emphasize that Beijing must address structural issues, from excess reliance on debt to insufficient consumer spending. These deeper issues are pivotal for long-term growth but require careful maneuvering from Chinese policymakers. As China's economic policies shift, the global markets are paying close attention. China's massive demand for commodities like iron ore, industrial metals and oil has driven prices worldwide, which are now fluctuating based on expectations of a Chinese recovery. A larger fiscal package could reignite demand and stabilize these markets, while a smaller one may prolong economic uncertainty. If China's economy continues to struggle, its slowdown will ripple across the globe, impacting trade, production, and investment in both emerging and developed markets. For now, investors and economies around the world are awaiting a clear sign from Beijing on just how big and enduring this stimulus might be. As Beijing prepares for the National People's Congress, where more details of its fiscal stimulus are expected, global markets are left in a precarious state of anticipation. Will China's new measures be bold enough to overcome debt risks and restore growth momentum, or will they simply kick the can down the road? In an interconnected world economy, China's approach to fiscal stimulus and growth will have a substantial impact, but only time will reveal the effectiveness of these policies. Stay tuned as we keep a close eye on China's economic journey and its effects on the global stage.